We're all struggling to digest all the new changes to the new tax act, SCURE 2.0. Here are a couple of ideas preliminarily as we read through it. A major piece of legislation called SCURE 2.0 was signed into law a while back, and in our qualified opinion, seniors win. Young people, however, who are being told that they win as well, may actually lose due to basic human nature. For our seniors, the rules around required minimum distributions from IRAs, also known as RMDs, were changed, moving the age at which they must begin from 72 and a half to 73 years old. Tax rules that run on age changes and dates are just easier to follow for most. As people are living longer and many are working past age 65, it was time to adjust those rules, which just a few years ago had required distributions triggering at age 70 and a half. It's scheduled to increase again in the future, so good rule changes for seniors and 2 thumbs up for us. For businesses, there were also some great changes to align Roth 401k rules with traditional 401k rules. Also, tax credits were increased, allowing small businesses to recoup more of the cost of starting a 401k plan. That allows small businesses to help their employees and themselves in the process. There's actually a great deal more in this area that's beyond the scope of this article, but more to come in the future. And again, 2 thumbs up. The problem we see involves the rule changes for working people who are in a crisis and need access to those 401k funds, which have been expanded to allow withdrawals in more situations without the penalties that normally apply. On the surface, this seems like a good idea. But when you consider the power of the long-term value of money, maybe not so much. People of all ages can encounter a financial crisis that causes them to need access to emergency funds. But the long-term cost to a 30-year-old taking an emergency withdrawal of, say, $10,000 from their 401k to cover an urgent and now exempt from penalty expense versus taking a credit card, borrowing from a family member, friend, or coworker, or almost any other source will be much higher than the same withdrawal would be for a 55-year-old. The lost earning power of that just $1,000 over that 25-year span will cause a significant reduction in the overall value of that account at retirement. Between mortgages, credit cards, student loans, and a variety of other topics, there has been a lot of legislation produced aimed at consumer protection and education, forcing companies to explicitly explain the true cost of borrowing money over time. Hopefully, at some point, that same approach will find its way into the rules and recommendations around these new options. But at first glance, there are none, and that's unfortunate. A young person in crisis thinks, all these scary notices I get from my credit card company have taught me that if I borrow $1,000 I need from my credit card, it'll cost me thousands if I don't get it paid back soon. So I'll just take that from my retirement fund. The fund isn't required to explain to them how much it will cost them in the long run to remove that money from the retirement account at age 30. As a country, we lost our financial discipline a long time ago, and it's got worse since the pandemic. More stimulus, more public welfare, and a national debt now over $31 trillion. Giving young people easier access to their 401k balances doesn't seem like a step in the right direction, when the message should be that's the last place on earth you would want to take money from. I'm Navy Dowdy, and remember, less tax, better life.